Good evening, everybody. I thought what we'd do is we'd split the presentation into three sections, really, and to cover areas that farmers can actually do something about rather than worrying about the areas that they can't. So we've got some fairly generic areas here, compositional quality and hygienic quality, which were covered in the two articles that went out on Monday and Tuesday this week. And then we'll look at some the volume incentives and penalties, in particular A and B pricing, a little bit later on. But before we get into the detail of this, one of the critical questions I think that we need to cover is whether you as a farmer know your customer. Do you know where your milk goes and what happens to it? And do you understand what your customer actually values? Because in theory, what the customer values will match what they're paying for in the contract, but that's not necessarily the case. And we'll see quite a few examples of that over the course of the next hour. Milk contracts only really tell us what the customer is currently encouraging to be produced, but not much else. And we also know that changes to maximise milk returns can take a number of years to work through. Therefore, if you're going to make some major changes at farm level, you need to be confident you're building a long-term sustainable plan aligned to your customer. So, for example, if you're supplying a liquid processor, somebody who's taking your milk and putting it into bottles, and they're currently paying for protein, on the face of it, that's not a sustainable position, because the customers in the liquid market can't actually get any extra value out of the protein at the moment. So if the farmer responds to those incentives, where's that extra money going to come from? The last point really is to think about what your customers' plans are for the future and whether they actually match your own plans for the future. Are they looking to expand or contract? Are they looking to introduce new technology which would perhaps make different parts of the milk more valuable in the future? The closer you can get to your milk buyer, which is your customer, the easier it is for you to plan your own business alongside theirs. So let's start with compositional quality and butterfat and protein payments. This is the chart that went into the article that went out on Tuesday this week. And what we've done is we've looked at all the milk buyers that we have in our milk price calculator, and we've looked at how much they're paying for butterfat and protein. And the chart here shows you what the average payments are, broken down by whether they're in the manufacturing market, liquid market, or an aligned contract. Unfortunately, this chart doesn't actually give us as much detail as we'd like, so I've actually extended that and dug into the detail a little bit more. So the horizontal bars on this second chart are the same ones that have just appeared on the previous one. They show us the average payment rates for manufacturing, liquid, and aligned. But what the vertical bars show us is the range in there. So, for example, for butterfat in a manufacturing contract, we have on average people paying about 2 pence per % for butterfat, but we have some milk buyers paying just over a penny and others paying just over 3 pence. For in the liquid market, the average again is just below 2 pence per %, but the range is much wider. We have a number of liquid buyers who don't pay anything for extra butterfat, and we have some that are paying nearly 4 pence per %. For aligned contracts, the payments on average are lower, and again we have quite a few who are paying nothing extra for the butterfat. Now actually, that's not necessarily logical, because in theory every milk processor in the country can standardise their product for fat. In other words, you can add fat or remove fat to get to the level of fat that you want in the final product. As such, butterfat should be valuable to everybody because it will either mean adding more cream or more cream available to be sold on. And the value should be relatively similar to all markets. The only real difference will be how much it costs to process that fat and turn it into cream. Protein is perhaps a different story. And we can see some wide ranges on payments for protein, particularly for the manufacturers. So the average payment rate there, just over 3 pence per %. But we've got some guys paying just a penny and others paying almost 6 pence per %. If you're supplying a liquid market, as we've already talked about before, actually at the moment there's not a lot of value in protein, if any at all. So we would have expected the liquid and the aligned averages to all be at zero. And actually quite a few of the buyers in the liquid market and the aligned market are paying nothing. But there are some, as you can see on the chart, in liquid paying more than 3 pence per %. The one thing I would just be very cautious of as a farmer, if you're supplying a milk buyer who's paying nearly 6 pence per % for protein, then that might be a good incentive to get a short-term gain. But I'd be very wary of that longer term, because if you're going to provide that extra protein, the key question is going to be, well, where is that extra money going to come from? Because nearly 6 pence per percent is a huge payment rate to pay for protein, given what the market values would be. As part of the analysis, we've also looked at what are farmers actually delivering. And the chart, again, was shown in the article on Tuesday, comes from the genus Milkminder data. So the sample size is only about 360. But actually, we have other sources of information which back up these results. The results are for a full year, so they include all the months. And we do know there's a seasonal pattern to fat and protein produced in the country. However, the point is that we still have a wide range of levels produced. And when we look at that additional information and break down where the milk is going to, there actually isn't much difference. In other words, in general, farmers are not focusing on their customer as much as you'd expect. That's quite a sweeping generalization, and there certainly are a number of farmers who are focusing on what the customer needs, but there's still a number who are not. The result is farmers are missing out on incentives, and these are in general incentives that would bring more money into the top of the silo and therefore filter through. But it's just as important to think about what isn't being paid for. So going back to that example we talked about with the liquid customer who pays nothing for protein, then you may as well get as close to the minimum level of protein as possible. Anything you produce above that minimum is a waste, and it's going to be adding cost somewhere through the supply chain. Finally, on compositional quality, we've seen some cheesemakers attempt to link the butterfat payments to the protein levels. The theory is right. The amount of milk needed to make a ton of cheese is mainly driven by the amount of protein in the milk, or more specifically, it's the amount of casein protein in the milk. That then determines how much fat can be retained in the cheese. So for cheese making, it's not just the amount of fat or protein, it's the ratio between the two that's important. The other interesting move, which unfortunately we've seen reversed by First Milk recently, was to pay based on milk solids, not on the volume of milk. Again, as a cheesemaker, that's entirely logical, and it's something we've seen done in New Zealand for many years. It's the fat and the protein that's bringing the value to a cheesemaker. The volume of water that comes in the milk is a cost. It's the cost to transport it, and it's actually the cost to dispose of it as well. If we move on to hygienic quality and look at the BACTA-scan, we've done the same analysis. So looking at our milk price calculator, what we've done is we've reset everybody to say if you're in the top band, that top band is 0. And then what we've said is where do the penalties kick in? And actually the charts show us what we would have expected to see. The aligned contracts do have more severe penalties kicking in earlier. And indeed some of the aligned contracts have clauses where they won't actually pilk the milk up when the BACTA-scan or cell count levels go above a certain level. And those certain levels are actually quite low. One thing this doesn't show us is the difference in how some milk buyers are actually calculating those averages. And that's actually one of the important areas that farmers should take notice of. In general, most milk buyers are using geometric means. Now, geometric means are historic payments that what they do is they remove or dampen down the effect of an unusually high result. However, for BACTA-scan, we know of at least one buyer who doesn't use a geometric mean. They use a simple 1-month average. The problem with that is if you have one high result in the month, it's going to significantly impact on your average and your payment average. Secondly, what does the buyer do with those outlying results? Does the farmer need to appeal? What's the appeal procedure and how often can they appeal? Again, we know of some buyers who will automatically remove outlying results, others who will wait for the appeal to happen. And remember that usually if you get one high result in 1 month, it's not just going to impact on the penalties for that 1 month, it potentially is going to impact for 2 or 3 months as well. And as we mentioned in the article, some of the incentives and penalties can actually be justified from the impact on milk processors. So for example, BACTA-scan, that's the measure of how much bacteria there is in the milk. And we know the bacteria will grow exponentially, which gives us 2 issues. Firstly, the higher the starting level of bacteria, the quicker the milk needs to be processed to wipe those out. Secondly, in order for that bacteria to grow, it needs to eat. And what it will be feeding on is the solids in the milk. So again, the higher the starting level of the solids, the higher the starting level of the bacteria, the more solids will be consumed. In fact, the fact that it has a direct impact on the processor's returns is actually good news, because it means an improvement on farm can actually be sustainable through the payment rates. Similar to the compositional quality, we looked at the milk minder results and the distribution for back to scan and cell count. And matching the results to individual milk buyers is actually quite difficult. But if we use those average payment penalties that we looked at earlier, we believe there's about £40 million being foregone between back to scan and cell counts from farmers not getting into the top bands for every month. Obviously, that impact is going to be highly individual, and we encourage farmers to use our milk price calculator to help see what impact hygiene penalties and bonuses are having on them as individuals, and what impact it would be if they managed to improve the situation. The distribution for cell counts is even wider. It's worth stressing that the hygiene quality in the country is amongst the best in the world, and it's continuing to improve. We've seen year-on-year improvements over at least the last 5 years. However, there's still room for further improvement, and it's something that's completely within the gift of the farmer. And getting back to the question of what the customer values, we also know that the customers are tending to increase the bans and make it even more severe going forward. So moving on to volume incentives. I think the first thing to note on volume incentives is that they're all about efficiency. So the idea is that it's more efficient to pick milk up from a few larger farms than it is to pick it up from numerous small ones. Of course, geography will also come into the equation. However, there are instant wins for the milk buyer on testing costs, admin costs, and haulage stop charges. They're not designed as necessary to encourage growth. They're more to reward the already large farms. So as a result, we have to be careful about driving higher volumes to gain volume bonuses. Volume bonuses are only really rewards for efficiency, and they don't take into consideration what's going to happen to that extra milk. So if a farmer produces more milk to gain an increase in their volume incentive, the milk buyer is left with milk that actually they're not sure what they're going to do with. And that's, I think, why we ended up with A and B pricing. So looking at A and B pricing, there are two volume risks for milk buyers. The first risk is what happens if their customer changes their requirements? What happens if the customer increases or reduces the amount of product that they want to buy? The second volume risk is what happens if the farmer changes the volume of milk that's being delivered to the processor. And there's not many industries where the customer will be taking that farmer supplier risk. So what A and B does is it de-risks that for the processor, and it passes all the risk back to the farmer. Now, in theory, A and B should be a good way to pass market signals back to farmers as quickly as possible. The B price becomes more volatile, while the A price remains more stable. As a result, the B price should go above the A price when there's a shortage of milk. Now, we haven't had a chance to see if this is going to happen yet. Although disappointingly, we have started to see some milk buyers react to the increases in commodity prices by dropping the B price altogether. Whether the B prices for those that remain with A and B will go above the A price is still to be seen. Now, one question we did get asked prior to the start of the webinar was about selling to more than one buyer. Now, there are not many industries where a single supplier is limited to a single buyer. Normally, your customer orders a certain quantity at a given price and you deliver it. If you don't have enough or you have too much, that's your problem. It's not the customer's problem. So the question is, could farmers do that in the dairy industry? Could they sell to more than one customer? Now, in theory, we see this already. We've seen this for a number of years in certain situations. So there have been producer-processors where a farmer is either processing some of the milk himself on farm and selling the remainder to a milk processor, or is actually getting somebody to process it for him. We've also seen with the expansion of farmers buying up other farms and ending up with multi-farms, and some of those multi-farms would be supplying different customers. However, individual farms selling to more than one milk buyer wasn't allowed under the quota restrictions, but those restrictions no longer apply to us. But there are a few implications just to consider on this if we are going to go down this route. First of all, milk collection. So if you've got all your milk in one milk vat, how are you going to separate it out to two or more customers? Actually, it's probably not as difficult as it sounds. We've got a lot of joint haulage that's already going on in the industry. And also, there's no rule that says that you necessarily have to split the milk each day. So effectively, you could sell 3 days worth of milk to one customer and 4 days milk to another customer. Milk testing is another area we just need to bear in mind. We don't want to duplicate costs by adding more tests into the system. But again, with milk testing, they're done in the country by probably 2 or 3 large labs, so there shouldn't really be an issue. Question on A and B pricing. Would it be possible for a farmer to deliver their A volume to a customer and actually sell the B volume themselves? But I think the most important point is the last one there, which is going back to some of the things that we've already covered today, which is how do you focus your production on a customer if you've got more than one customer with differing customer requirements? So the extreme example would be if you're selling to a cheese customer and to a liquid customer from the same farm. Those two customers will have very different requirements for milk, so it would be difficult to focus attention on both of them and maximize returns from both. So just concluding, there are opportunities that are available to farmers. Short term, it's really about understanding your contract and looking at some of the areas where you're missing out on those available bonuses, and our milk price calculator can help with that. But longer term, it's more about understanding your customer, understanding what happens to your milk and the valuable elements to your milk. And then it gets down to that short-term gains versus long-term goals calculation. Thank you very much.